the first UK webinar of autumn. It's hard to believe that we're already in the first week of August and that so much of 2020 has flown by. So for many of you, I'd like to welcome you back to our UK webinar series. And for anybody who's new with us this week, if you're with us here for the first time, I'd like to welcome you too. Of course, I'd like to welcome our speaker today, Simon. Simon is an R&D expert, and Simon has been working on R&D claims over the last 20 years. Simon advises accountants, but Simon has also built a beautiful piece of software that accountants and tax advisors can use to help them and help their clients deal with R&D tax claims. So Simon's software, for any of you who are interested, is called quantify.tax. That's quantify.tax. So Simon is a solicitor. He comes from a legal background, and he has a tax background. He's an unusual character, and I love Simon's session. So I'm delighted that Simon is here with me today. What are we looking at in terms of R&D tax credits? Well, really what Simon is looking at is, how to make a good claim. And part of what we're going to do today is he's going to give us 4 case studies. Now, I love the way Simon has brought in these case studies, because what he's doing is he's highlighting case studies that HMRC have commented on where there was issues. There's no point in looking at all the ones that just flow through. So in his case studies, Simon is highlighting some of the problems and some of the issues that are arising. And then Simon is going to say, well, and demonstrate to us how accountants, tax advisors can make more robust claims and have claims that will stand up. There is a real risk here. And there's a risk in everything that we do as accountants and tax advisors. And the risk is that something goes wrong, and now we become the target. In such a litigious society, when things go wrong, people are more likely to sue now than ever before. And yes, of course, we have professional indemnity insurance, but the whole point of Simon's session is to cut off some of these risks that can arise. And we spoke beforehand how revenue to date in the UK have not necessarily gone heavy on inspecting individual claims, but Simon is going to share his insights into some of what is happening, and also the fact that the tide can turn here on this at any point in time. So Simon, what we might do is you might just introduce yourself and give some context to you, why people should listen to you, your expertise, and then also to share the slides. Now, anybody that wants to share the slides, if you're here on Zoom with us, so I know some of you watch us, join us on Zoom. If you're here on Zoom, down the chat box down below, Jonathan has shared a link. But if you're watching in either the Facebook group, you're watching on LinkedIn, or you're watching in the recording, download the slides and the material for today's session now. And Simon is going to introduce himself and bring the slides up on screen.
Great. Hi everyone. Good to be here. Thanks, Des, for the intro. So yeah, as Des said, I am excuse me, I'm a tax qualified lawyer. So I've worked in law firms, accountancy firms, R&D firms, and I've been doing this for 20 years. So what I wanted to do is kind of share some of the experience that I've had from that, and some of the war stories. We often hear a lot of people in the R&D space saying how rosy it is in the garden, and so I thought it'd be interesting to actually share some of the insights.
Did you qualify as a solicitor first, Simon, or did you qualify in tax first?
I qualified ATT first, and then as a solicitor, and then as a chartered tax advisor. So, and it all happened in a short space of time. I've got one of those CVs that really reads like a sign of a wasted youth.
Excellent.
Not enough hobbies, but great. Let's bring the slides up.
Super. Yeah, you're sharing there. They're coming through loud and clear, Simon, on my end.
Perfect. Okay, so yeah, so those are the timings. We're going to fly through some of this, and there's plenty of time at the end for questions, and so that'll be good. Yeah, so the title of this one's Lessons from the Frontline of R&D, and it is topical. It's all up to date. my core message for everyone is that R&D tax relief isn't rocket science. I know that, you know, there's this sort of cliched phrase of you don't have to be doing rocket science to claim R&D tax relief, but equally, the process of actually claiming it itself, that's not that hard. It's R&D tax relief has been with us for 20 years. And I know there's a lot of people out there that say, okay, it's off the beaten path. I'm still not used to it. I'm still not confident in this space. I think, frankly, it's time as a profession that we were more comfortable in tackling R&D tax relief, and use the tools that are available to identify what can be claimed and what can't, and to build better relationships with our clients so that we are accessing the information that we need. So I'm going to share some of the insights into how you can do that through this. So yeah, don't be scared of R&D tax relief is what I'm trying to say. With just brief structure of what I'm going to talk about. It's not going to be 45 to 60 minutes. It's going to be briefer than that, but we're going to run through some case studies, and then we're going to talk about the problems with assumption-based claims, which is probably 90% of what's going on in the market at the moment. We're then going to talk about addressing client churn for those that have had R&D clients for a long time, maximizing your efficiency as an advisor, preventing PI claims where opportunities have been missed, and then also handling R&D inquiries, which are now creeping back up the agenda for everyone.
I presume, Simon, looking at your overview here, the problem with assumption-based claims, in R&D, of course, there is an element of assumptions. There is assumptions inbuilt into the process, but I presume that HMRC is less comfortable with assumption-based claims than claims that are based on actual, tangible, identifiable expenditures incurred. And that this is one of the nuance areas, that the more assumption-based the claim is, and the less strength there is behind those assumptions, the more at risk that ultimately the company is, but also indirectly the advisor is.
Absolutely, yeah. And it's a difficult nut to crack, this one, because for a lot of businesses, they haven't heard of R&D tax relief, and so they haven't kept records that support a claim. But because most of the value of any claim is based on how much time your staff members have spent on a qualifying project, then you do have to kind of bridge that gap. And the way a lot of people do it is just to sort of pick a percentage and say, well, it was half of that person's salary, 3/4 of that person's salary, 20% of that one. And that's a big old assumption. I mean, you couldn't get away with that if you were putting together a mileage claim. You couldn't just assume that 20% of all the miles on that person's car have been business related. And so the revenue they've got a reasonably relaxed attitude to this, but when you see people that are making claims for, just sort of tens and tens of thousands of pounds year after year, when you get into sort of the 4th, 5th, 6th year of doing that, the revenue quite rightly say, come on, let's get some proper figures here. And so
I think there's two things in there, Simon. The first thing for me in there is you wouldn't do it with an expense claim. Okay.
Yeah.
So you wouldn't do it with an expense claim. But I think the second issue appears to be that revenue haven't exactly been clamping down on this, coming down hard. R&D tax credits are around for 20 years. And, there's a level of comfort that's built up around this because revenue haven't been beating the drum on it, and they haven't been going hard, despite the fact they're well entitled to.
Absolutely, yeah. And I think that level of comfort has slipped into complacency in a lot of quarters. People are now regularly not putting together any real effort at substantiating the figures that are going on the R&D claim, and they're waiting to see if there's an inquiry. And yeah, I mean, the inquiry rates are terrifyingly low, and it's really now reached a point where, as an area of tax advice, there is a lot of risk. There are people in there now making claims that that don't stack up. It's not, I see a lot of silhouette as a man. That's I'm going to stop singing Queen. I see a lot of R&D claims that come to me at the point that the revenue have started to take it down a more sort of aggressive inquiry line, which, you know, naturally with my background being as a lawyer, then at the point that it starts to become potentially a tribunal or a litigation position that needs to be managed out, then I see a lot of that, and the claims I see are shocking. People have just shoved in any figure, and then just assumed that they'll be able to make the evidence base for it after the event. And the revenue quite rightly say, no, you need to have your records in place at the time that you put the claim together. And so yeah, so really, you know, having the right tools to be able to put the evidence together, that's the important bit, and that's really where the Quantified Tax platform comes in. Yeah,
okay, so
some
many of you are returning visitors. You're here with us live. I see David, you're a fairly regular attender. John, Michael, Linda. So there's some regular attenders here who are familiar. If you have any questions, folks, if you're live with us on Zoom, put the questions down below in the chat or the Q&A box, and Simon will field them. If you're watching through LinkedIn, if you're watching through our Facebook group, Accountants for Growth Facebook group, wherever you're watching, if you put any questions that you have down in the comments below, Jonathan is going to feed them through to us, and Simon will field those questions as we progress. Okay, so Simon, let's get stuck in.
Cool. Okay. Yeah. So for anyone who is not sort of familiar with R&D claims, I just really want to give you sort of 2 seconds on what's the point of it. What's the value of an R&D claim? And most claims that we'll come across are SME claims. So claims for you know, the smaller end of the market. Now, your large companies are huge in this case. They've doubled the usual limits. So you're talking 500 employees plus massive turnover or massive balance sheet. But yeah, that sort of 500 employee threshold means that we actually come across very few of the large company claims generally. So the way the SME claim works is you identify qualifying costs, and then you multiply those up by 130%, and you get an extra enhanced corporation tax deduction for that, which translates into about £2,500 tax deduction for every 10,000 of qualifying cost. For a profit-making company, it's going to save £2,500 of every 10,000 it spends. For a loss-making company, it can actually get payment from the revenue of 3,300 there. For a large company, that works as an above-the-line credit, so it's a line of income, hits the P&L, and then that is itself taxable. So large companies get in effect just over £1,000 on every £10,000 of qualifying costs that they've got. There's a couple of subtleties that we'll come to as we go through the talk, but yeah, in terms of value, yeah, it is a significant amount of value that you can deliver to a client if you're helping them make an R&D claim. So yeah, going with the flow of R&D. So where's the beaten path is what I wanted to sort of touch on next. So with that, we're going to run through 4 case studies, and as Des mentioned earlier, the point of these case studies is to share the war stories. You know, let's talk about sort of what's been learned from the ones that the revenue have actually looked at. And yeah, I think I mentioned, you know, I do see a lot of HMRC inquiries because I'm fielding those for a lot of accountants up and down the country. But yeah, there are definite themes as to what the revenue look at, and I think it's
is revenue investigation and inquiries, Simon, in your opinion, is it increasing? Is it staying the same, just with more diligence? Is this a landscape that's shifting at the moment, or is it just that the ones that they do inquire into, they're getting more hardline?
It's shifted. There are now more inquiries. Definitely seen, you know, an awful lot more this year than over the last few years. And I think, everyone will admit that there's been far too few inquiries over the last 20 years. There's been very few. I know, R&D practices that are out there that have never had an inquiry on any of their cases, and my view on that is, I know the rules are clear, but they could be doing things very wrong and they've just never been picked up on it. A mentor of mine says, you don't know where the line is until you've stepped over it, and I think there is a lot to be learned from an inquiry that people haven't had the benefit of that experience of working with the revenue to understand what the revenue want and what they don't when they see these claims. There are a lot of subjective terms. So what are the 4 you've
picked out for us to showcase the issues, Simon?
So the ones that I've picked out are around sort of misassumptions by the revenue, and just I wanted to highlight kind of the experience of the inspectors that we're dealing with and the type of questions that you get, and really why evidence is key. The weight of evidence and the way that it's presented to the revenue is really the difference between an inquiry going smoothly or it turning into a nightmare. So yeah, let's dive into this first one. This is a fabrications business, so they make rain screens, these things that are on the side of that building there, and they've had a lot of benefit from this over the past 5 years. £1.25 billion of tax relief coming tax that they've saved that would have otherwise paid on profits. And so they were doing new product development. Now, a lot of their products look the same. And so when the revenue made an inquiry into this, which was sparked by something else that made them open the year generally, and they saw the R&D claim, and they said, well, let's have a poke into that as well. And the claims that the company had been making were all around new product development. And that was around doing basically the same thing, metal panel on the side of a building that stops the rain getting in. But they were looking at how can we make these things more efficiently, and how can we make them easier to be fitted onto the side of the building? How can we make the installer's job easier by the physical sort of way that the panels are put together? And the revenue were really not impressed. The inspector that we came across in this, who had no technical knowledge of engineering at all, came at it from the point of view of, you're doing the same product, it still looks the same, it does the same job. And the thing that we got that sort of swung it over the line there, in the conversation with the inspector, was that there was a patent on this new method of manufacture and new method of installation. And so being able to say to the inspector, look, there's solid evidence that this is an innovative product. We wouldn't have been able to get a patent unless it more than met the requirements of the R&D regime. That got us over the line with that inquiry. But it was alarming to have to persuade someone who knows nothing about the engineering space that something is innovative in that way, and really having that extra evidence that the patent was in place was very important on that one. Of course, you don't need a patent. And on software development, this next case study, it's very difficult to get a patent for anything to do with software. But
just on the first case study, Simon,
yeah,
and one of the joys of having me on a webinar with you is that there's limited preparation, and I could be throwing you under a bus here. But let's say I've got a fabrications business like the one that you've just described, and you kind of had a nervous times trying to explain to revenue, look, this is what it is. What was the alternative solution here? What would have made it easier for somebody else who has a fabrications business that the HMRC haven't come knocking yet? What should they be doing to lessen the risk?
There's a lot of weight in the evidence that you keep around a project, and so with a fabrications business, any kind of engineering manufacturing business, they tend to just fly at things at 100 miles an hour. So they've got a problem, they fix it. They don't sort of sit around drafting up a plan of how they might fix it first. And that means that by the time that the revenue is asking the question, you're often 18 months, maybe 2 years, 2.5 years down the line from when that innovation took place. And so if you then sort of say to the guy who was on the shop floor hitting things with a hammer, what was that about back then? You know, either he didn't solve it and so he's forgotten about it and moved on, or he did solve it and now it's run of the mill. And if you ask him what was difficult about it, he'll have a vague recollection. So it's all about keeping the records at the time that they've got something challenging in front of them. And
document as you go.
Yeah, absolutely, absolutely. And so it's a difficult discipline for a lot of people to get into. So we try and make that as easy as possible for them. But yeah, coming at this after the year end, after the accounts have been put together, generally, you know, after the tax has been put together, and then when the client says, "Cracky, I've got a big tax bill," and you go, "Oh, I wonder what we can do to reduce that. Let's have a look at an R&D claim." You're so far after the event that you're really swimming against the tide. Yeah.
Okay, so the next one is software development.
Yeah. So yeah, this one. So with this one, there was system uncertainty that allowed us to make a claim here, and the revenue were looking at it saying, "Hang on, actually, what you've done here is not sort of amazing. You haven't broken new ground. You haven't sort of changed an industry with this." And the way that we ended up explaining this to the inspectors was that. Integrating different elements into a system can involve a lot of uncertainty about exactly how you do that. The revenue cracked down a lot on software development at the moment, and they've actually recruited a team of experienced software developers, and they've taught them tax to be able to filter out some of the frankly dodgy claims that were coming through. And people have put any app. Let's stick in a claim for any app, and app development really over the last 10 years has become standard form in a lot of cases. And unless you're doing something that is genuinely innovative in how the software works, so the revenue aren't interested in the commercial opportunity. Just introducing a new bit of software into an area of industry that hasn't had software in before isn't enough. The software has to operate in a technically difficult way.
Yeah, you see, and that's I do see that as a problem, because in terms of innovation, when we work with our CTO always says to us, our external technology officer, he says, "Okay, well, is there an existing, rather than us developing something, is there an existing product there that we can innovate and build on?" And what he says is the vast majority of software and technological evolution now, that you can usually take something that's already existing and add on features. But that doesn't actually meet the definition of R&D, because you created a new commercial solution, but it's actually just plugging existing stuff together. It's not new or innovative.
Yeah, that's it exactly. And that, I mean, this is an area that a lot of accountants and R&D advisors really struggle with. Is if a client says to you, "I believe this is innovative because nobody's had an app in the hairdressing space before," then at what point do you feel comfortable saying to the client, "Your developers have just got a WordPress website and they've plugged in a couple of things and they've put your logo on it, but that's not innovative." The client's often very proud of
innovative. It's innovative from a commercial perspective. It's innovative from a client perspective, but it's not actually innovative from an R&D perspective.
Yeah.
There's a great question in here, Simon, and from Pauline. So Pauline is asking the question: do you think that the advance assurance is worth doing for a first-time claim on R&D?
No, in a nutshell, not for R&D purposes. So there is that option of doing it, and the revenue come back with some. It's not cast in stone when the revenue come back and say, "Yes, that looks innovative," and actually it doesn't even hold that much weight if an inspector decides to make an inquiry into it, because after the event they can always say, "Well, actually, you did something different." I haven't seen them do that a lot, but I've certainly seen the revenue say, "We're not bound by an advance assurance that we've given." The value in advance assurance that I've found is for companies that are looking to go and raise investment. So if they can wave something at potential investors saying, "We've been pre-approved in effect for an R&D claim," then yeah, investors are a lot more comfortable putting money into that company rather than one that hasn't taken that step. But you've got to do pretty much the same work. It's only minus a few figures. And so do you do the work early and charge the client for it at that point? Or do you do the work when the claim can actually go ahead and charge the client when they've got some money to pay you for it? Yeah, from a practical point of view, I don't find it useful.
Okay, so sorry, Simon, I interrupted you. I'm not sure where you finished on your software development case study.
No, on this one. So there was a bit of kind of discussion with the revenue about what constitutes a valid bit of software development in innovation terms, and it was the integration of kind of relatively off the shelf things with actually quite difficult legacy systems that caused the system uncertainty, and it was very much a case of, well, if they'd have ditched the legacy systems and just started from blank canvas, there would have been a beaten path in terms of software development, and they wouldn't have had a claim. But having to integrate it, choosing to integrate it with a legacy system gave enough uncertainty there that there was a valid claim. But this was actually done for the software developer involved did it for a client. So they were paid to do this. Normally that would rule you out of being able to make the claim because the claim belongs to the person that's paid for it. But where a large company subcontracts work out to an SME, the large company can't claim any of those subcontractor costs. And so the subcontractor, if they're an SME, they can actually claim as though they were a large company. So this was an RDEC claim, a large company claim made by an SME. And that's a point that gets missed a lot. So I just wanted to just kind of flag that up as well. And that was actually, it was something that came back. One of the questions from the revenue was, hang on, you're an SME. What are you doing making a large company claim? So sometimes you do have to kind of explain these rules back to the revenue as well. But it's all in the legislation. It's fine. But a lot of the inspectors that you come across haven't got a very broad experience of R&D.
So large company can't, just clarify for myself, large company can't make the claim based on the subcontractor costs, but the subcontractor, despite being an SME, can make the claim on their own behalf under the large entity regime.
That's it, exactly. Yeah. So the SME makes an above the line credit claim, and that would only be for their salaries, consumables, and utilities that have been involved in it. So if the SME subcontractor has subcontracted out work to other people, they can't claim that. Large companies and then anyone under the large company regime can't claim for subcontractor work. Yeah.
Okay, so the next one, you're looking at Fitbit or some of the wearables.
Yeah, that sort of thing. Yeah. So the software that goes into these watches, it wasn't an Apple Watch, but it was that type of thing. For this one was about 3 years ago. The software that goes into it's not massively different to the software that runs generally, but using this new form of technology, the interactives on the wearables, the sensors and all that sort of thing, and finding how to map all that together, used kind of existing processes, replicated existing software processes, but using a new form of technology. And the revenue were very against that. They said, come on, this software works the same on this device as it does on that device. But there was a period when it needed to be demonstrated. And so the client that I handled this claim for had to demonstrate that their development was on pre-release developer kit that wasn't out there. It wasn't in the wild. And so there was no known way of doing this because nobody else had their hands on that kit. And so for a period of 6 months when the prototype kit was around and these guys were developing the software that would be on it when it was released, then they could claim for that. But basically, as soon as this kit went out into the wild and other developers got their hands on it, the ability to make claims based on just the novelty of it being on a new device, that just disappeared. So this was a very time limited claim, and the point I wanted to draw out about this one was that we needed evidence to demonstrate that the development had happened on that pre-release kit, and so the time stamping of this project was really important. If we didn't have evidence that it happened between January and July, and the revenue said, hang on, this was out in the wild. Loads of people were handling this kit in October to November. So, how can you prove that you were actually doing anything on kit that was novel, kit that was new? We
I have this
needed
cool
to
little
have
gizmo here.
Oh, what's that?
Simon. That's called it's a timular, and basically it's a way of helping me keep track of time. It automatically records your time. When you're talking about time stamping a project, do we need something like timular? Do we need something like timesheets? Or do we just need to document, well, projects? Like, do you and I need to have timesheets as a backup? Or do we just need to document, well, this week we worked on this element of the project, and then next week we worked on this other element? What level of detail do you need in terms of time stamping to stand up to scrutiny?
Well, the more the merrier, really, in terms of detail that you've got. When you're looking at the way that most people put R&D claims together, it's almost like what proportion of someone's job description relates to R&D. And so when you put a claim together and you're basing it on 50% of that person's salary, you've got no evidence that you don't know whether they spent the first 6 months of the year, the second 6 months of the year working on something, or was it kind of half of every day? It's far too vague, but that's the way that most people have made claims, and the revenue have accepted claims made that way in the past. Certainly haven't, there hasn't been wide scale challenge of that. There is now, a movement from the revenue when they're challenging these things to say, how do we know what you did when? It's not plausible that somebody spent half of every day through the year working on R&D. So timesheets are beyond what they expect, but they do expect something more than just a kind of a guess, particularly a guess that's happening 6 months, 9 months after year end. So if you can sort of keep timesheets, then that's great. But the Quantified Tax platform, another good plug there. Actually, it has a system in there for clients to be able to make a little bit of narrative, just to sort of describe briefly what a project's about at the time that they're doing it. And so that, and also for staff to then tag their time against it, which happens on a once a week or a once a month basis, and it's in sort of number of days. How many days did you spend on that? Half a day, 3 days, a couple of weeks.
So your Quantified.tax app would allow people to actually tag. Maybe they have sophisticated timesheet systems. Maybe they have other timesheet systems.
Yeah.
But it allows them just tag into one place. And of course, if there's more data behind it, put it in. But at least this gives you something in real time that you can count on and rely on in the future.
Yeah, I mean, the nightmare scenario is when you've got a tax inspector sat in front of you saying, where did you get that figure from? And if you have to hold your hands up and say, made it up, sorry, I had a chat with the client, we just decided 50% was fine. No one wants to be in that position. So if you can say, we use this system, the client staff inputted their time, and yeah, it's not down to every 6 minutes as we would probably record things, but it gives you a starting point for a discussion. It's not based on assumption. Yeah.
I'm smiling to myself here, Simon, and I know I shouldn't be smiling, but I still can't believe some of what happens in the real world at times, in relation to tax compliance. But I think you raised the point at the start. It's just that people get comfortable, and when we get into the comfort zone, it sort of, sometimes common sense gets diminished. Like, of course we should have the records for this. Of course we should have the records.
Absolutely, yeah.
So the time records were critical of that case study one. So the next one, I think you have Simon's product design business.
Yeah. Now this is one of my favorite case studies. It's a device that you stick in the end of a golf club, and it tells you what angle you're holding the club at, the shaft angle, how open or closed you are, all that sort of stuff. And yeah, this one helped. The fact that there was an R&D claim there allowed the client to attract some investment more easily. It's my favorite case study because it helped me win at golf. I was terrible at golf. I'm still not good, but I'm a lot better than I was. Relatively simple technology.
So when you solved the problem and everybody was able to relax and take a sigh of relief that their R&D credit wasn't going to be overturned, they gave you one of the devices for free. I always love clients like that, Simon.
Yep, and I've used it at many golf days, and generally, when people see how much my golf has improved, the client then gets to sell more of their gadgets. So it's excellent marketing for the client as well. But yes, this was a relatively simple bit of technology, but when we explained to the inspector, how it had been used and the impact it was having for people,
So for example, is this technology that was deployed somewhere else and you converted it to golf, or was it golf technology that was just redeployed in a different way?
It's just a bog standard accelerometer. That's the same thing that you have in a mobile phone that tells you what angle you're holding the phone at. So for a lot of games that you play on a phone, just tipping the phone one way or another, or if you want to change from portrait to landscape, you just sort of flick the phone around, and it's that same technology just shoved into this that tells you the different angles that you're holding the club at, with a really simple dial on the front, just giving you some of those angles that you can read. But yeah, so the technology doesn't have to be staggeringly complicated, but if it's used in a different way, then yeah, that can satisfy a claim as well. But
before we go on to the preparing to make a claim section, there's a question in here from Yogesh. I hope I pronounced your name right there, Yogesh. Any recommended material I can read to teach myself R&D? If you were directing somebody, Simon, to a resource, or where would you send somebody who's relatively new to R&D who wants to become a category authority in this area?
The revenue manuals are good. I don't praise the revenue all that often, but actually their manuals are pretty strong in this area. But if you wanted something that's less in depth, there's a lot of material in the revenue manuals on this. Then if you send me an email, we'll be sharing my email address at the end of this. Then there's the Quantified Tax Fundamental Guide to R&D Claims, which is a really cracking read. And I can share that with people, and that'll give you all of the pointers that you need on what to do and how to do it. And
so what was the title of that book, Simon?
It's something snappy like Fundamentals of R&D Tax Relief. Yeah, I can email that out to people after the event, or you can sign up for it on the website. And yeah, okay. It's a good little guide through of how to do it. But actually, using the Quantify platform is a great place to start, because as we'll I'll glaze over this bit when we get to the slides in the talk later on. But yeah, the idea with the platform is to really rebalance the role of the advisor and the client. So that at the moment, a lot of R&D advice is given in a similar way to bookkeeping from 10 years ago, when someone would turn up with a carrier bag full of receipts and say, turn that into a set of accounts. But now so many people are using Xero, where they're putting all of their records in for you, and the client does a lot of the work on the reconciliations and all this kind of thing. So the accountant's actually got a starting point to look at and give some advice on the back of. The Quantify platform does very much the same thing. It says to the client, look, set your projects up, spend a bit of time, log some time against it, and then we can tell you if it qualifies or not later. It doesn't cost the client time and energy to do it, because it really is sort of 5 minutes. 5 minutes for people to add their time, 5 minutes to set up a project. If that happens once a week or once a month, by the time you get to year end, you've actually got more than half the claim is there and built and ready to go, where you can add the gloss, change the wording, qualify things in or out. So it is a very useful tool, but less of a sales pitch, more intel, hopefully. Preparing to make a claim. This is so important. From years of discussing this with inspectors and handling a lot of inquiries, just want to share a plea from them as well. They don't want to see 20 pages of technical narrative. So a lot of R&D providers talk about the importance of having suitably qualified people prepare the claim. But when you've got a retired academic or a kind of an engineer that writes something that's 20 pages long of technical jargon, the revenue inspectors don't understand it, and they shouldn't have to. You should be able to describe really clearly and plainly why your claim qualifies. And if it needs 20 pages of technical stuff to do that, then you're probably trying too hard. 1 or 2 pages per project is perfect. The revenue inspectors spend 20, 25, maybe 30 minutes reviewing this. So if they need to read something that's going to take them a day to read and understand, you're not going to be in the good books. Defined and evidenced start and end dates are critical. That's the big thing that the revenue ask about now. They don't want to see kind of 20% of someone's salary forever is related to R&D. They want to know, what did you do? When did it start? When did it finish? And they're not interested in the company history or CVs of the team. It's not a funding pitch. The rules are pretty simple. What's your advance? What are you inventing? What was the uncertainty? Who did what? And why wasn't the solution to the problem that your client was looking for obvious? Would somebody else in the same industry have found a solution to that problem quickly and easily? If you can answer those 3 things, then you're away with the claim. But you need to be able to clearly and concisely communicate the answers to those questions to a tax inspector who's not got a lot of time or interest in your client. And so, so sending them something 2 inches thick isn't gonna help. so that's really, don't be daunted by an R&D claim. If you can't explain it clearly, then don't make the claim, or at least pass it back to the client until they can make the claim in clear terms for you. Things that are often missed is we've touched on one of these earlier, which was the one about the work being paid for by a large company. So that's missed in an awful lot of cases, and the statistics show that that's really not a very popular claim for companies to make, which doesn't tie in with reality. Proof of concept work for a potential customer. A lot of clients think that you can only claim for stuff where it's actually led to a successful outcome, where they've gone on and actually developed the product or won some work. And it's not that, it's the thinking time that goes into it. And a lot of people have to spend thinking time trying to win work that they don't win, and you can still claim for that. And then indirect activities, there's a lot of management and admin time that can be brought into a claim where there is a good link between the activities and the project, not just sort of 10% of everyone in finance's time, but where there is where you've had to recruit someone into an R&D team, definitely claim the time from HR in that respect. We've talked a bit about this one already, so I'll skip over this. This was saying, make sure you've got timely evidence. Ask the client about the R&D throughout the year, not as an afterthought after the accounts have been put together. And assumptions, as we've talked about, assumptions can lead you to the wrong path. The number of R&D claims has gone up year on year on year, and the revenue quite rightly expect going forward for there to be fewer claims made, and they want them to be higher quality. We've reached that tipping point now where they are starting to police more than promote, and there are a lot of people putting in unsubstantiated claims. They want to weed those out, and for everyone that carries on making R&D claims to make better quality ones. And the way to solve that problem of how do you tackle the assumptions is to just gather evidence, put the tools in the client's hands, give them a software package for them to be able to maintain records, to add some time in to keep track of their projects, so that you've got a starting point for the discussion rather than having to go on big percentages. The quality of records is absolutely going to be key. Over the next 3 to 5 years, the people that have got good quality records are going to be the ones that the revenue looks at once and then leaves alone. If you take a long time putting your answers to inquiries together, then the revenue are going to know that you're probably making it up after the event, which is a big risk indicator for them. No.
Okay, so just one thing, Simon. Anybody here who missed the intro at the start of this session, if you have any questions, wherever you're watching with us, just put your question in the comments down below, present them to Simon. He's answered a few questions live here. ask your questions. What is relevant to you here out of this session? Simon has factored in the time to answer your questions. So, sorry, back to you, Simon.
No, great. I should probably explain on this one as well that a lot of my clients are in the cycling industry, building bits of bikes. It's my passion, and so this picture's actually got absolutely no relevance to the slides at all. It's just, you know, I like putting pictures of bikes on things. So apologies. You'll see a few more as we flick through the next few slides. So no blanket percentages. Yeah, if you're making claims based on, you know, 20% or 50% of someone's salary, then you're doing it wrong, and it's not good enough. It's never been good enough. Yes, you can get away with that for the first couple of years, but then you have to start improving the quality of your record keeping and asking the client to do that. You know, yeah, as we've mentioned a few times, this is something that needs to happen.
Simon, where R&D goes wrong, how many years do HMRC go back?
It varies. They do tend to just go back sort of, you know, one or 2 years, but where they see that there are no records, where figures have been put on a tax return that aren't substantiated by any records, then they've increasingly started to tag that as negligence. So they're going back much further. Yeah, and I've got some sympathy for them in the way that they do that. Or they'll find a way of sort of, you know, opening it up and then saying, well, the level of risk that it associates with this client means that we're not just looking at R&D anymore. We're going to, you know, open it up across the board and start looking at PAYE, VAT, just corporation tax, just everything.
Yeah, so it's a gateway to everything.
Yeah. If you put one unsubstantiated number on a tax return, it's you're asking for trouble. Yeah.
And I think the difficulty that we were talking about beforehand, Simon, is that very compliant taxpayers, very compliant advisors, that everything else may be compliant, everything else may be tip top, but if there's slippage here, it is a reflection on. It can sometimes almost be a false reflection on the reality of the taxpayer's attitude and the advisor's attitude. Absolutely. And people get led into that by R&D advisors who come along and say, well, we've prepared this claim for you. There's the number, stick it on the tax return. And it really is sort of incumbent on the accountant to unpick where's that come from. And a lot of R&D advisors, you know, the rumor has it that salespeople drive the figures because they're taking 25 to 30% of the value of the claim as a fee, and so when they're advising the client on how big their claim should be, then a lot of the time that the fee influences the figures, and so that puts the client at an undue amount of risk. And the real difficulty in that whole scenario, Simon, is that the real difficulty in that whole scenario is we've got the client here. We've got the tax advisor here, and we've got the R&D company over here. But when the shit hits the fan, the R&D company is gone. It's the accountant and the tax advisor are primarily in the firing line. Yeah,
and the accountant can say, well, you know, I didn't advise. I introduced you to someone else who did this for you, but you know, technically, legally, contractually, that's correct. But the relationship with the client is, you know, on a practical level, it's a difficult one to repair that bridge. Whereas, you know, if you have put the power in the client's hands, if you said to the client, look, you tell me about your R&D, use this bit of software, and then we'll review it together later on. If there's anything difficult comes out of it, we'll pull in a specialist to advise on particular areas. You've managed the relationship in a much more collaborative way, so the client feels less like they're relying on the advisor. So if there is an inquiry and something goes wrong, you've had that discussion with the client throughout the process, and you haven't lost the trust of the client at that point. And yeah, I would, I'd say it might just be the prism I see things through because I'm dealing with R&D, you know, most of my time. But I see the R&D as being the number one reason why people leave their relationship with their accountant. You know, if they feel as if they've not been loved, they haven't had proactive advice, they've missed an area where they should have had some advice, then they'll then start to question that relationship, and they'll go, well, if I take my account somewhere else, maybe I will get that added value, that extra advice from someone else. And so if someone comes along banging on the door saying, I think you could have made an R&D claim, but you've never had that conversation with your client, then yeah, the client's going to question the relationship they've got with you. And if someone else does stick in a claim for them, and it doesn't get checked by the revenue, and they do have what's perceived as a successful claim, they've got to check back that someone else has organized for them, then yeah, their loyalties are going to shift across in that direction. And it might well be a claim that's gone in just on a hit and hope basis, which is how a lot of people are doing these things. So I think having an ongoing discussion with the client, being able to qualify things in and out, being able to say to a client, no, I see you've told me about this project, but that doesn't qualify because. That's a really powerful conversation to be able to have with the client, and builds trust. If you just say, yeah, fine, everything you tell me about qualifies, I'll stick the number on the tax return, then yeah, you're not doing the client a proper service, and that in itself does undermine the relationship as well, because it is a touchy-feely subject. And so clients do need to have.
You're talking there about existing dialogue. Clients, Simon, and you're talking about sort of, I would feel, existing client churn. What about more mature clients and people who've previously had R&D claims? Let's say somebody comes to me and they say, right, I'm not happy with my existing accountant. Where do you start with a new client coming on board in relation to R&D?
So with a client who has already been making R&D claims for a number of years, the number one bugbear that the clients talk to me about, and which accountants talk to me about, how can we deal with this issue, is the astronomical fees that are charged. People are still routinely charging 25 to 30% year on year on year, and when you've got a client who's been paying those sorts of fees for 3 to 5 years, they do start to feel the pinch after a while. I mean, there's fees on R&D advice are a fairly open goal in the early years. You can demonstrate the value that you're bringing to the client, because they look at it and say, well, we wouldn't have otherwise had this money. We've been given a check for £50,000 from the revenue. Yes, I'm more than happy to pay a £10,000 fee on that. Clients are happy with that. But then once they start to see it more as compliance rather than an advisory area, where the client's leading the advice, then increasingly they do talk about fixed fees, capped fees, that sort of thing. And that's, being able to offer a differentiated process to mature clients is really, really important. Not all clients need to have their hands held through the entire process every year. If you are doing that for the first 2 or 3 years that you're dealing with a client, then absolutely, a value-based fee is appropriate there. But then once you get to that point where the client doesn't, you've educated them, you've enabled them, so you're in more of a processing and checking and review mode rather than leading the advice, then the fee basis has to shift, and the way that the work's delivered has to shift as well. And that's where
you're touching on something, Simon. I kind of wear 2 hats. I wear the technical hat, and then I wear the Profit Pro hat, which is the one about accountants generating more value, more profit in their business. So I think part of what you're touching on there is it's the ongoing requirement. If you are going down a value-based billing route, it's the ongoing requirement to reinforce the value to the client, to reinforce the value to the customer. And even, Simon, when we talk about your Quantify.tax app, we could just say Quantify.tax, and well, then why do I need you? I just use Quantify.tax. But it's how we introduce. This is a tool to help us get the result. The documentation is a tool, but as we go on, it's to move R&D tax credits out of that area of letting them slip into compliance. And is from a revenue perspective, Simon, does percentage fees and how specific providers operate, does that raise any red flags?
Yes, it does. Yeah, yeah. The revenue have been identifying certain sort of players in the market and looking at them, basically, identifying people that have been putting together weak claims, where there's a disconnect between the person that puts the narrative together and the person that puts the figures together, and quite often the figures just don't tie into the narrative at all, and so. When the revenue have been looking into that, they've identified that actually a lot of the time the figures are put together by people that are directly financially motivated by the size of the claim, and they're questioning that. The number one question that comes out of a revenue inquiry, initially, is who led the process here? Was it the client or was it the advisor? And if it was the advisor, was the advisor doing it based on a percentage-based fee? Because it just rings too many alarm bells. If assumptions are going to be overcooked, was it the client that did that because they actually know what's going on, or was it an advisor who's overcooked the assumptions that are in the claim in order to get a bigger fee? And that's something that's causing a lot of concern on a regulatory basis as well. The government talks about this being an area of undue influence over the tax regime, and they would much rather see accountants in a position where they can put these claims together. Accountants are trusted advisors. The regulator and the government believes that when an accountant does a job, they do it in a professional and diligent way. When it's outsourced to an R&D provider who is led by fee incentives, then that trust and respect is eroded. So yeah, there's a lot of the talk about how the regime might get amended is about simplifying it to a point that accountants are comfortable putting claims together. So there's less.
I think, Simon, what I'm hearing and what you're saying, we talked earlier about the collateral damage for businesses. If a business puts in something, no matter who's responsible, if a business puts something in a tax return that's unsubstantiated, that could be false, depending on the seriousness and how HMRC feel about it, that's going to open up the entire business to scrutiny. But then you've got the bigger issue, which is you as an accountant advising, or tax advisor advising a client, and now they find problems in one R&D claim. That opens up the accountant or advisor to scrutiny on their entire portfolio. And it appears here, based on what we were saying before we started this session, that when it comes to R&D, that revenue are definitely taking a supplier focus and not just a market focus. So if one supplier has a problem on one claim, they're looking at all of their claims, and then they're looking at their entire operation.
Absolutely. And there's a lot of these providers will say, we've got 100% success rate. I've never had the revenue question one of my claims. And that shouldn't be mistaken for a thumbs up from the revenue. That just means that actually the revenue have inquired into less than 1% of claims that have been made. That person's they haven't had the revenue look at them. It's not a thumbs up, it's a nothing. And people shouldn't be sort of, using the revenue's lack of making inquiries as something that gives them any more credibility in this market than anyone else.
The bottom line here, Simon, for me, and I'll move to you for closing comments, but the bottom line for me here is that accountants and tax advisors are the best positioned to do R&D claims. And accountants and tax advisors, if the client has the tools to capture and harvest the information and the data, you've talked about time stamping, the allocations, the assumptions. If the stuff is captured in real time, well, then there's no reason why the accountants shouldn't be able to do this. It's critical to get it right, but it's not beyond complicated. Like, accountants do VAT, they do capital acquisitions tax, they do capital gains tax. So yeah, very specific things we might get into a niche that's beyond our capabilities. But the accountants can well do this. It's a capture and recording, and that, Simon, really is Quantify.tax solves that problem. Your app. So, what are your final comments before we wrap up, Simon?
Thank you very much. it's been a pleasure and a privilege to be able to share this insight with people, and yeah, it's the message is absolutely, this isn't an area that is too difficult. Don't be put off by fear of the unknown. It's not something that you come across day to day, but with the right tools, this is something that can be handled in a way that you can build your confidence in this area. And
it's not just the app that's there, Simon. You're there too. Your client base is accountants. You're working with accountants every day of the week, tax advisors every day of the week, navigating this whole area. So the app gives the platform for the client. But if somebody feels out of their depth, you're there to give the steer.
The principle I've always worked with when designing processes and systems is only do what only you can do. And the client is the only one in a position to tell you what they've been doing, right? So give them a tool where they can do that. And then the accountant is the only one that can manage that relationship with the client and have that relationship with the revenue as well. So they do that. At the point that the accountant says, hang on, there's something here that I'm technically uncomfortable with, uncertain about, then yeah, refer it to someone else and give that to an external R&D provider who's got the experience to be able to handle that technical aspect of it. But you shouldn't be asking that external provider to do the entire process. Don't ask them to do everything and gather all the information from the client as well. The client's perfectly capable of doing all that, and that if you take that only do what only you can do approach, then it really just makes everybody work more efficiently. It keeps the accountant at the heart of this process, this value-added advisory process with the client. The accountant's in the driving seat there, and that's so important for the relationship.
I love that piece of closing advice. Simon, thank you so much for coming on today. I want to thank our technical team and marketing team for making today happen. Particular thanks to Dermot, who helps us recruit our speakers throughout the UK. I want to thank you who are here with us live, those of you who are here with us on Zoom, and those of you who are here with us on LinkedIn or in the Facebook group. If you want to register to be part of to get these webinars every week, we're now upping the webinar rate to 2 a week from the month of August going forward until the end of the year. You can register. Jonathan is going to put a link up in the chat box where you can register to attend all our webinars. You can share a link, or you can share that link with your colleagues and peers. These are free webinars. They're going to be free webinars for the foreseeable future. We've given you the link to Simon's www.quantify.tax is where you will get Simon, and you can email Simon at quantify.tax if you have anything else coming out of today's session. So thank you, everybody. Thank you, Simon. And until we see you again, let's get it done.
Thanks, everyone.